turn it over to you.
Okay, thank you, Helen. First, I'd like to start off by thanking and introducing our sponsors. Our platinum sponsor is Sensiba San Filippo. Gold sponsors are First Citizens Bank and Five Star Bank. Silver sponsors, Chicago Deferred Exchange Company and Golden Pacific Bank. Bronze sponsors, BFC, US Bank, Exceed, Investment Property Exchange Services, and Rubicon Mortgage Fund. And our media sponsor is San Francisco Business Times. We have virtual monthly meetings like this one, the second Tuesday of every month from 10 to 11. So please look forward to those and schedule those in your calendar. Every month we'll be going over a different topic. We also have our deals and drinks on a monthly basis, typically the third week of the month, where we just get together for networking and introducing deals that various members or people on the call are talking about. And we have our virtual mentoring sessions as well. And want to announce that next Thursday, the 18th, from 10 to 11 a.m., Helen will be presenting her book, and she'll be interviewed by Eric Wren. Eric Wren is himself a broker here in the East Bay. Helen has written a book about her life and her career in real estate, talking about growing up in another country, immigration here, building her career, and helping other people change their lives. So it's very interesting. So my name is Max Shapiro. I want to introduce our panel today. So I run Novature Capital, and we do capital advisory and debt and equity placement for commercial real estate operators. Our panel today, whom I want to thank, consists of 4 people, all involved in the office market here in the East Bay and in the Bay Area in general. Moderator is Chad Arnold. Chad is with Colliers here in East Bay. He is involved in both sales and leasing, tenant and landlord representation. He's an executive vice president. Prior to his time here in the East Bay, he was an executive vice president with Colliers in Northern Virginia and Washington, D.C. Chad has over 20 years of commercial real estate experience. The panelists are Kurt Chambliss. Kurt is with TMC Financing. Kurt is also an over 20-year veteran of the commercial real estate financing world. He's got SBA experience for that entire time. He is expert in dealing with businesses, helping them to purchase properties. He knows all the in and outs of the SBA financing process. He's been with TMC since 2010 and is a top producer here in the East Bay for them. Simon Vogt is a broker and principal with Lee & Associates in the East Bay. Simon is involved in both leasing and sales of commercial properties, office and industrial mainly. He does tenant and landlord representation. And Mike Zylstra with Newmark Capital Markets. Mike has also been in commercial real estate for over 20 years. He's located here in the East Bay, dealing with sales and dispositions of commercial properties, mainly office and industrial. So I want to thank you all. Looking forward to hearing what you have to say on a very interesting topic. And Chad, I will turn it over to you. Oh, one more thing. I apologize for the audience. As you have questions coming up, we have questions that the panel has discussed and we'll go over, and we will get to audience questions certainly before the end, and if appropriate throughout the program. Please put your questions into the Q&A box, and we'll be reading them from there. Thank you, Chad. Turning it over to you.
Great, thank you, Max. Thank you, everyone, for having me. We appreciate the opportunity to be here today. I think generally, just to kind of kick it off, there is a lot of questions, a lot of uncertainty in the office market these days. It's no secret what COVID has done to this market, unlike the industrial market, which seemed to really kind of benefit, from the changes that occurred during COVID. But office really has taken a major hit, in large part due to the fact that many people during COVID were forced to work from home. Now it seems to be a expanding trend. And we just want to try to, discuss today, sort of give everybody an idea of where we think the market is going forward coming into 2022. I know all of us office guys have an idea where we'd like to see it go, but what we'd like to talk about today is kind of where we think that is happening, where that is going. So if I could just start off, I'd like to start with Mike and Simon and Kurt, just a real quick kind of story, or just anecdotally what you've seen over the past, say, 20 months. Simon, why don't we start with you? Sort of, what have you seen in the office market quickly happening since since the lockdown occurred originally, which was going to be 2 weeks, obviously extended much longer. What are you seeing in your business?
First of all, good morning, everybody. What I've seen really was a hard stop come end of March, obviously about a year and a half ago. And it very slowly started picking up maybe towards the end of last year, and then started quickly slowing back down again. It finally started picking up, at least for myself. I do a lot of Class B and smaller office leasing and sales. I would say maybe in April, May of this year. And it's been pretty steady, I would say, in the Class B Tri-Valley office market for leasing. Not so much the Class A product I have, but the Class B has been pretty active in the smaller sector. I think you were touching a little bit upon the working from home already. I've seen less working from home in the Class B smaller office tenants than I have obviously in the larger office tenants. The big corporations obviously don't really let anybody come to the office, but a lot of the private small companies, like for example ourselves, we've been coming to the office, I would say probably for at least a year already now again.
Yeah.
Also, I do a lot of owner user sales. That's picked up quite heavily, thanks to people like Kurt Chambliss helping out with great loans. And there's been a push for purchase of small condos and small buildings here in the Tri-Valley. We just don't have enough inventory to satisfy all the demand for it. I have definitely seen an uptick though in activity over the last, I would say, 3 to 4 months for sure. What's been pretty stagnant though are the larger space. I would say anything over 10,000 square feet has been sitting. But anything like 1,000 to 5,000 square feet, we had a decent amount of tours. Our tour activity has picked up.
Good. Mike, how about you? Mike, you do a lot of sales. And sort of where, maybe just explain quickly where your focus market is, and then what you're seeing in your business.
Sure. Thank you. It's kind of been somber, so maybe we can do a follow-up one, and we can do it during your deals and drinks meetings.
Yeah.
That might be more appropriate. But in any case, we took a look back on historical numbers to kind of give you a better sense of it, and we used CoStar data, and we picked buildings greater than 10,000 feet and sales. And so the first tranche we picked out was from November of 19 through November of 21. And deal transactions was 140 and total consideration of about 3.1 billion. The 2-year period prior to that, so from 2017 to 2019, the start of the pandemic, was 230 transactions and 4.5 billion. So we're down about 40% in the last 2 years on transaction numbers, and we're down about 30% in total consideration. I think the total consideration is a little bit skewed because there have been some significant life science institutional transactions that have taken place. I think you did a good job of saying, but I work in the private capital, so typically transaction size 30 million and under, which has slowed quite a bit because we're obviously tied very, very closely in suburban office with occupancy rates and leasing, which kind of leads us into those numbers, which is, at the start of the pandemic, and this isn't the entire East Bay or Alameda and Contra Costa County, but it's a subset. So the North 680 marketplace here, Walnut Creek, Concord, Martinez, Danville, La Marinda. And that's about 17 million feet in total inventory. We are currently at 21% vacancy. Pre-pandemic or Q3 of 19, we were at 14.5. So a significant increase. But then if you go back to the Great Recession, at 2008, we had 11% vacancy and we went to 20%. So it was much more significant, which was interesting because I really thought, the pandemic numbers were more, there was going to be more contrast.
Yeah. Do you think there's, to Simon's point about this not being enough product in the market, do you think there's pent up demand on the buy side?
I do, but I don't think it's a matter of, well, it's a combination of not enough product, but I think the story behind that is the reasoning. There's just not enough demand for suburban office when you don't know when people are coming back to work.
Sure.
Kurt can speak to that too. The financing is critical in the capital stack for acquisitions of these office assets. And if you can't, underwrite whatever rent growth or occupancy for the next 2 to 3 years, if you're throwing darts at a board, lenders are not going to get behind you on that kind of acquisition.
Right. Kurt, that's a perfect segue into you. What are you seeing in the market, or what have you seen change significantly? And maybe at the same time, what do you see coming down the pike?
Sure. So, what a year, huh? You pick a time as, okay, talk about, this 20 months ago or 12 months ago, but maybe just the last 6 months, at least from the SBA side, we saw stimulus. Let me just say that within the CARES Act, there was a lot of stimulus programs that made SBA financing even more attractive than it usually normally is. And there was a big demand this summer for SBA financing to take advantage of those benefits, which ended in the end of September. So now we're going to be returning kind of a normal time as far as the fees and the no free payments and just standard pricing. But that standard pricing is still really attractive. And so I don't see any let up in the demand for the financing we have. But I'll dovetail both to Simon and Mike. Lack of inventory is just a consistent theme. We are seeing more smaller spaces, the kind of those class B in a sense, the 5,500 to 10,000 square foot office buildings are getting demand, but the larger ones, fewer and far between. And then to what Mike said, I lost my train of thought. Mike, you had a very interesting point. I wanted to comment on it. Maybe while you're thinking about that for a second, are you seeing that most of these buyers that are taking advantage of the rates today, because it sounds like rates are attractive, are they mostly users that are purchasing today? And I did remember what I was going to say. So the lending is critical, and my area is SBA, and that is a particular subset of the overall market. It's a small but powerful subset. The overall lending from commercial non-SBA is very tough, from what I understand, to make those numbers hit and to make it a worthwhile loan for the bank to do conventionally. Looking at rental income, not knowing what the work at home situation is going to materialize to be, I think conventional lending, you're going to have to put 40%, maybe even 50% down on some of these properties in order to make the rent rolls work. Whereas on SBA, with the owner user stuff, we can still do 90% or 10% down. Yeah, and that's to touch on Mike's point. because it's just so hard to underwrite occupancy rates and
Yes.
rental rates today, right?
Exactly, correct.
Yeah, okay, all right, great. Simon, how are you seeing office market rents, current rents perform in the market today? Are they stable? Are they dropping? Do we see an increase in rental rates over the past year and a half? What's your experience?
I think it took a while for owners to realize how long this is going to take. COVID initially, I think there was kind of, this is going to be over in a few months. We're going to hold to our rates pretty tight, which I don't want to say the smart owners, but some owners have definitely reduced their rates, and those are the ones that are seeing the deals. The ones that are holding to their rate, to the asking rates, I think are the ones that are not seeing deals. Just kind of give you an example. I mean, Class B stuff here and or Class B office product in Pleasanton used to go for somewhere between $250 to $290 a foot, depending on the building. I would say now you see those somewhere between just over $2 to maybe $250 on the high end. So there's probably about a 20% in reduction of actual deal rates versus where asking rates used to be. Also, I see a way bigger difference between asking rates now and actual deal rates, meaning a landlord might still ask, $260 a foot, but there's a wink rate of like $2 or $210 out there.
Right.
We've definitely seen that. So yes, probably 20% less than pre-COVID rates, I would say, on the Class B, and I'll let you, chime in on the Class A stuff, Chad.
Yeah, I mean, we're seeing landlords hold pretty tight on Class A asking rents. What we're seeing in part trying to hold those face rates, and Mike, you could maybe talk to this a little bit more, because obviously the higher the face rate, the higher the valuation of the building. Class A landlords, especially wall landlords, hate to drop their face rates, but what we're seeing in exchange is more concessions from the landlord. We're seeing more spec suites in the Class A market that are being leased at less appealing terms. For example, 3-year deals, where normally, if a landlord has to put $65 to $100 a foot, sometimes more, into a spec suite, normally in the past, we historically see a 5+ year term on that so they can recoup that investment. And now they're willing to do those deals at 3 years. Otherwise, rent abatement has increased slightly. Sometimes, depending on credit and term, they'll come off that face rate a little bit. And then obviously TIs, we're having to do shorter terms because for the same TIs, because companies just don't have the foresight what's coming down the road. I mean, trying to ask somebody to do a 7 or 10 year lease today, they don't know what's going to happen in 6 months. So people are very hesitant to go that route.
Yeah. I'll add to that too, Chad. I mean, I've been doing a decent amount of renewals lately, and usually, as you probably know, renewals are 3 to 5 years, kind of standard.
Yeah.
A lot of 1 year, maybe 18 months renewals, just to get over that hump. And a lot of landlords don't want to lock in these low rates right now either. So some of the landlords also want to do shorter renewals versus doing.
Yeah, they'll do a short renewal at a lower rate, knowing that they can, hoping that they can increase that rate at the end of the 1 or 2 year renewal cycle.
But then turn, of course, that can hurt what Mike was saying earlier. If you have shorter terms on leases, harder to underwrite a building.
Right.
Investment sale.
Yeah, which brings me to my next question. Mike, what are you seeing on building sales? Are sales that do occur, are prices holding steady, or are you seeing sellers have to drop price to get buyers in leased investments, not user sales?
It's been interesting because the capital that's available, or even 1031 trade buyers who are obviously motivated to close within a set period of time, and they have to, or they face potential serious tax ramifications.
Right.
The assets that they would chase and what we've experienced them executing on have been still safer than what I consider a straight down the middle suburban office building. For instance, a 50,000 foot medical office building in downtown Berkeley that we closed a few months ago. a government lease deal in Sacramento that, the tenant had been there 21 years. So there was a good, strong argument for the lender. We haven't seen a lot of change in the pricing on those. I wouldn't say we've seen cap rate compression for certain, where, in the institutional world, you're seeing compression on life science and Google and tech and Facebook leased buildings. We haven't, but so there's been less activity, obviously, but it's been more for medical office buildings, or if you have a good, strong, weighted average lease term remaining on your asset, then you're getting a lot of activity. We track a lot of 1031 trade buyers through our private client group on the West Coast. So, we've seen successes there. I wanted to just comment really quickly, not being a leasing expert, but obviously tracking it and sitting in with our monthly leasing meetings, more on the landlord side with the Class A assets that our group represents. Like you said, Chad, there's a strong desire to keep coupon rates or the starting rental rate close, if not where it was pre-pandemic. There's a number of reasons for it. One is a lot of these institutional owners had bought buildings in the 3 to 5 years leading up to the pandemic, which was a very strong time. So they own assets at high basis. They've got investors to answer to. So to take a $5 full service rent building and then say it's pandemic, I need to go to $3 to make this deal, I don't think that sits well with anybody.
Right.
So they're doing the concession game, if you will, and a lot of those are under NDA, so you'll get comps, but there'll be coupon rates. The other thing the pandemic has done, and we all know, is increased the cost of materials.
Yeah.
And then addition to that, the double on that is that employees and craftsmen, it's difficult and more expensive to find them. So, a $70 TI from the past or a $50 TI could be $75 or $100 today.
Yeah.
And when you've got, downward pressure on rents, it's a complicated algorithm. So we're seeing a lot of landlords, and this was happening prior to the pandemic too, that they want to improve the experience for tenants in their buildings. So you see a lot more amenities, whether it's outdoor barbecue areas and gyms and showers and improvements on TIs as well. I think because of the amount of time we all spent working from home and eating our home cooked meals, there's a lot of tenants that want to get back in and want to be close to amenities, restaurants. So it's the experience, and I think the strong landlords are using that to compete on as well.
Sure. Yeah. You mentioned increase in cost of materials. That's part and parcel of why, the concessions are increasing in this market. It's not because landlords are saying, oh, you wanted plain vanilla space before, how about I build you the Taj Mahal? It's just costs 30, 40, 50, sometimes double the cost to build the same vanilla space as it did a year or 18 months ago. So, from a landlord's perspective, it almost doesn't pencil, right? I mean, the rates are hanging tight or dropping, but cost of concessions are going through the roof.
Yeah,
makes it difficult.
Yeah, we've definitely seen TIs be cost prohibitive to do transactions, lease transactions. We've passed on a decent amount of proposals now because the TIs.
Yeah.
I mean, you can't even recoup in some cases the TIs over a 5-year lease. If you actually bring the full service rate from a Class B office space down to an actual net rate, I mean, you might be
losing money.
Yeah, I mean, you lose money on a transaction. So obviously those landlords will pass on those deals.
Right. Kurt, do you allow owner users to finance tenant improvements, or does that come out of part like your, 10, 20% down? It's all kind of blended.
We absolutely allow
in.
that. Yeah, absolutely allow it. It's probably, maybe in a third of our transactions that there's some type of tenant improvement work being done. So, and what you do is you just take the purchase price, you add in the tenant improvement cost, And then you get to your total project cost, and we can do 90% of that total. Now, the appraisal has to pencil out to support those
Numbers,
costs.
yeah.
But we
Sure.
haven't,
The loan to value ratio.
right, but we haven't had appraisals. I mean, appraisals are taking a lot longer. They're busy, but so far they've come in and they've supported all the costs that we've had on those as complete projects.
Yeah. What about personal property like AV and furniture? Do you allow that to be baked into the loan or no?
Yeah, well, let's take an example of the medical professionals, or I should say professional services is our biggest industry. That's the biggest industry that SBA supports. And of that, I would say medical professionals is probably the number one sub industry. Dentists are very important to us. And so
Sure.
dentist wants to buy a building, commercial condo, they want to do their own TI work, but then they also have furniture, some equipment and some small fixtures that they want to include into the project. So all of that stuff can be added into our total project cost and finance 90% of that total.
So it's a case by case basis, it sounds like.
Yeah, but it just seems dentists in particular always want to do some type of TI work.
Yeah, gotcha. Okay, well, to move on and kind of address the elephant in the room, why don't we talk about work from home a little bit, because I know that's on every commercial office broker's mind today. We're seeing industrial buildings being utilized to their fullest potential in most cases. The industrial market's been white hot during the pandemic. Office has really fallen off, and we spend a lot of our time these days. All of us, I think, Mike, I probably speak for you and Simon, and Simon, I know you and I have talked about it ourselves many times. Are people going to be called back to the office? I'll just start out by saying real quick, in my opinion, and I'll turn it over to you guys. I think that this work from home initially, pre-pandemic, was something that many companies were trying to work towards. But I'll use Yahoo as an example, where they said, we're going to have people work from home. They tried it and they went, okay, never mind. Everybody back to the office. This is not working. Now you hear a lot of discussions about how production has gone up. People are more productive at home. They're happier. You don't have the commute, et cetera, et cetera. But when we talk to CEOs of many of these companies, they strongly disagree with that notion, and they say actually production is down. I just spoke to a CEO the other day that said they can monitor, activity on workers' laptops, and sometimes they'll look and somebody's been inactive for 3 hours, right? They're not doing what they're supposed to be doing if they're not on their computer for 3 hours straight. So, let's sort of talk. Mike, maybe we'll start it off with you. Are you finding that a lot of office users are hesitant to call people back to the office? And why do you think they are, if that's the case? Obviously, people are not being called back. So sort of what's your forecast? What's your take on this, and what's your forecast for the coming year?
I think the hesitation, I think our group think here was, if you go back 6 months ago, that come Labor Day, there was going to be, a huge flow of everyone back into the office. It seemed like everything was under control, and then the Delta variant came.
Right.
So we didn't see that. Our market out here is a lot of finance, real estate, service, attorney groups, et cetera. So, we've heard varying numbers on, how much more efficient these workers are in the office from, or away from the office, being 75 to 80%. So I think it's somewhat a question of when some groups do start coming back, and if you're a client or a potential client and you look to one large real estate, and I'll use real estate attorney groups as an example. And if you're looking to one and they're, you call them and they say, we can have you into our office, we're protocol safe, everything, sit down, have you here tomorrow morning, meet the team, et cetera, et cetera. And if that costs X, and then the next group you call says, okay, we're gonna have a Zoom with you tomorrow and introduce you to the crew, and we still charge X, why would the client take that if you really think it's 20% more efficient to go with the group that's working in-house next door to each other? So, I mean, that's one view on it. My own personal experience here with the offices, we've been coming in, a small subset of us, pretty much since the beginning of the pandemic.
Same here.
I have a team of 3 of us, and then we have a couple of support people who they have a certain number of days a week where they do work from home still. We're just far more effective and efficient when we're here together. And Max on our team is a younger guy, and so he needs just the experience. I mean, hearing people on the phones and interacting with clients.
Right.
It's impossible to do that.
There's a certain degree of corporate culture that you want to build and train and maintain, and you're just not going to get that working from home.
Yeah, I agree. Simon, what are you seeing? What's your take on it?
So I touched upon it briefly earlier. I feel like the small companies, like you guys have touched upon, like CPAs and lawyers already. I deal with a lot of those small CPAs and attorneys firms. I feel like those guys started coming back to the office relatively quickly, even last year already. And then the others, I do a lot of, Kurt touched upon it, dentists. I do a lot of dental sales and medical sales and leasing, and they never really stopped. I mean, it was maybe end of March to, I believe it was like June 1st when they were allowed to come back, and they haven't stopped. So the people that have to come to the office, they were pushing against, government ordinances really quickly to come back to the office and start working. I mean, the 3 of us here, 4 of us here, I don't think any one of us, worked from home for much, longer than maybe a month or so, right? I mean, I started coming back, I think in April or May last year already, just because you got to show space. I mean, I can't do that from home.
Yeah, right.
And, working with my partners in my office, I got, we got 15 people roughly here. It's way different doing that over Zoom calls than, actually coming to the office and seeing people and collaborating and coming up with ideas. And I mean, for me personally, working from home doesn't work. And I know a lot of my clients, it also doesn't work. I mean, there's other factors that come in, like family and kids and stuff like that. It's just,
Yeah, it's hard.
Yeah, it's hard. So you need the space away from home. And I feel like that's true for a lot of my clients too. Yeah,
I've found that the conversations I've had with folks that are all in on the work from home and think that we're never going to go back to the office are the ones that really, really love working from home. Right? It's the ones that are like, we're never going, I don't ever see it happen, and it's never going to happen. I go, yeah, because you can't get out of your pajamas. But if, the folks that really see the value in it, they're pushing hard to get everybody back. And maybe we can touch on this, not to beat a dead horse, we can move on from this in a minute, but it seems as if everybody's looking at the big guys, Facebook, Google, Apple, Yahoo, to go, what are they doing? When are they going to call everybody back? And it seems as if when that happens, because we already saw it, like Simon, you said, someone mentioned Labor Day. We saw a big rush in activity after they let everybody come back. Then the Delta variant hit, and it's like that we slammed on the brakes. I feel like when the big guys that everybody has their eye on call everybody back in this market, Silicon Valley, then it's going to be a big rush to get back to the market. I mean, we've already seen an uptick in traffic. I know a lot of the banking, industry, Wall Street, they're saying, no, I want butts and seats. Everybody's coming back to work, and you're doing it tomorrow. They've called a lot of people back, like Citi. Do you tend to agree with that? And then I'll just kind of put one more layer on it. If that happens, what's going to happen with all the folks that were convinced work from home was here to stay, then they all left the peninsula and moved out here to the East Bay, that are now going to have to commute an hour and a half. Mike, let's start with you.
It's a strange one. I'm not sure they all just moved to the East Bay. I think a lot of them moved to Tahoe and Nevada and
Montana.
Everybody experienced, upward pressure on residential real estate. So
Yeah.
I'm not going to pretend to know what that's going to mean. I think there is definitely going to be some percentage of, you can work one day from home, or, two, whatever it is. I think there's going to be a percentage of that for a lot of industries going forward.
Right.
I would say that I think, California is obviously one of the leading states in vaccination percentage. So maybe we're going to, be one of the states that leads on, everybody back to work. I think when, some of these big companies bring them back, others are going to follow. I would like to think that it means, the vacancy rates on office properties in suburban office markets like we have here are going to improve vastly. But we've had that story for cycles, all the cycles in the past 20 plus years.
Yeah.
And we've only seen it to a limited extent. I think pre-pandemic we were seeing it, but it was for different reasons. I think it was a combination of quality of life, that, some of these bigger tech companies were moving out of downtown San Francisco and, going into Oakland. So there was a little shorter commute to get to, their office. So I'm hopeful that we're going to see some of that, a little more in the suburban, if you can call, Oakland is clearly not suburban, but, that and kind of out this way to Tri-Valley and the Walnut Creek markets.
Yeah,
Definitely hope for more satellite offices for these larger companies to come out here.
Yeah, and get in opening satellite offices.
Yeah.
To be closer to employees. Yeah. Yeah, I think we'll see a benefit for that. Kurt, are you seeing a lot of biotech or R&D companies looking to purchase in the East Bay now and leaving the peninsula?
That's limited in our area. I mean, it might be booming in other types of lending, but not necessarily SBA. We're for office. We have the medical professionals, which you're required to be there in the office, right? So you're a surgeon or you're a chiropractor. I mean, you gotta have office staff, and you gotta be there for your patients.
Got it.
But then the other industries or office industries that we work with, law firms, engineering firms, consulting firms, accounting firms, those I think that the genie's out of the bottle to a certain degree. I mean, many of those people are going to want to continue to work from home, but they still need that corporate culture. They still need the collaboration. They still want it. So I think Mike is right that you're going to have a hybrid, and you're going to have 2 to 3 days a week of coming in and 2 to 3 weeks of. But then how do you set up your office in that space? You do the hoteling where you don't have your office, but you have a space that you move around from.
Right.
So then maybe you need less space. That's just another facet to investigate. Yeah,
and then Mike, that touches back to what you were talking about with vacancy rates. There's two sides to this. What we see is we were getting to the point pre-pandemic where they were putting so many people in a space that it was actually becoming a stress on the buildings, right? On the HVAC systems, on the parking, on the elevators, because benching was so popular, they were trying to put more people into smaller space. Now that part of the debate is, okay, are we going to go back to more office? Are we going to have to separate these people? Is it going to go from 175 feet per person in tech company per rentable square foot back to the 200 to 225 that we've seen, prior to this benching model? So it's going to be interesting. I do agree with Mike that we're going to see vacancy rates drop again, but I don't know how
that's, you know, is it gonna be more people? Is it gonna be more space? How is this gonna kind of happen? Mike, what's your take on it? I mean, what are you, I mean, I know I'm asking you to have a crystal ball here, but sort of what do you think is gonna happen? Higher rentable per person, or where do you think it's gonna go?
Sorry, was that for me?
Yeah,
Yeah, I think it's going to be more. I think we're going to get away from kind of the collaborative model that was taking place in San Francisco and Oakland. You know, with 10 or 12 employees per 1,000 feet. I think we're going to go the opposite direction some. So, you know, does that mean we go back to, you know, four per 1,000 or 5 or something? So I think it's going to be more space to kind of lure employees, make them feel safer and more comfortable. I don't think we're going to go to building more privates and go back to a private environment. I still think it's going to be open and collaborative. I just think you're going to have more space for fewer employees.
yeah, got it. Interesting. So do you see, and Simon, I'll direct this one at you, do you see landlords starting to pull back on concessions coming into the new year and into 2022? Do you feel like landlords are getting a little more confident?
No, not yet. At least not on the deals I'm working on. There's also, I mean, it's been what, a little bit less than 2 years. So, you know, a lot of the leases we're dealing with were done before COVID still, right? So we're still dealing with renewals that were you know, started, or the leases that were started before COVID. So I think we're still going to see a little bit more of downsizing of tenants. You know, their leases are now finally coming up. Their 3-year or 5-year leases are coming up now. So at least what I'm dealing with on a decent amount of suites, where tenants don't need 5,000 feet anymore. They only, you know, downsize into 2 or 3, at least temporarily, and then try to figure it out next year. So no, I mean, I don't see landlords cutting back on the concessions of anything, or I'm still seeing a little bit of more of an uptick on that.
Yeah. Kurt, do you anticipate there'll be more buyers coming into the market, coming into the new year as things stabilize?
I do. Yeah, I know. We're forecasting another good year, and I know this might not resonate well with a bunch of office people, but in general, SBA financing did pretty well last year. And but if I just looked at the office space going forward of this year, I still think it's a great time to buy if you can find the right building for your business. With the rates, and we can lock in less than 3%, 25-year fixed rates. That's just 10% down. It's just incredible opportunities to solidify your future occupancy cost, and we just think that's going to continue to happen for the next 6 to 12 months.
Kurt, I have a quick question for you on that. With these low rates, I know you do a lot of lease versus purchase scenarios for clients. How often do you see the lease actually be better than the purchase? I feel like it's probably almost 98% of the time that the purchase scenario works out better than the lease scenario with these low rates.
That's, yeah, we love to do those lease versus own scenarios. It's just a one sheet that gives a really good overview, and the payments are usually in line, the lease payment versus the new mortgage payment, but the bigger impact is just the return on equity and the appreciation. Even if you put a very modest 1.5% to 2% appreciation rate in the model, it over 10 years, it just is just exponential with the return that you get on your 10% down payment.
So given rates are so low right now, is this a good time to refi if you bought a building in the past 5 to 10 years?
The other neat thing that came with the stimulus package was a expansion of refinancing using SBA 504 to refinance your existing loans. And number one, we can give cash out up to 20% of the appraised value, and then we can re-amortize the existing loan, which even if you keep the rate the same, you know, re-amortizing it is going to, you know, lower your cost. And then of course the you know, reducing the rate and locking in these rates versus even a few years ago, 5% was, oh my gosh, 5%, I'm so happy to get my rate, 5%, and that's a great rate, but you get 3% now. It's just much better.
And do you anticipate rates going up in the next 12 months?
Probably in 12 months, yeah, but I don't see anything in the next, 6 to 9. I think that we're still pretty fragile, and we're still coming out of a pretty major disaster that we had, and I don't think that there's going to be natural. We've already seen some slight upticks. You look at the 10-year Treasury; it's going up a little bit, but relatively speaking, I think we're going to be in a low rate environment for 6 to 12 months.
Yeah, Mike, this is kind of an obvious question, but I'll go ahead and ask it anyway. But
Chad, if I can just intervene real quick.
Yeah.
I just want to remind the audience to put your questions in the Q&A box. We do have one question in there. So Chad, after you, I guess we're going to ask this next question. If we could take some time for audience questions, that would be great.
yeah, sure. I was just going to say, Mike, how's that going to affect our office sales if rates go up? It's, let's say, institutional buyers versus, a user owner. That's going to negatively affect prices, but I guess what I'm getting at is, let's talk about institutional for a second. As vacancy rates decline, rental rates stabilize or tend to tick up a little bit. Are higher interest rates going to negatively impact the pricing on office product, or is that going to the demand is strong enough that they'll figure it out and cap rates will drop?
I think anytime that you have a material increase in the interest rates on your debt portion, it's going to impact, somewhere along the capital stack or the demand, without question. And it also, you have to weigh in other alternative investment types. So yeah, on the institutional side, and that's, that's a high level kind of view. I would say more on the private capital side, while interest rates are still attractive today, we have clients who have done, refinancing on suburban office buildings where, they're only at 80% occupancy or something, and the rates are almost obnoxious compared to what they've experienced for the past 5 years. They're north of 5% in some cases, and in some cases higher, and these are not high leverage loans. So I think the impact on interest rates is, you can have quoted rates that look very attractive. The suburban office building, for the reasons we said earlier, is forecasting and understanding occupancy. We may be at 3.5%, but for that building, we're at 5 or 5.5%. So it's already having an impact.
Okay.
Mike, do you see I know you mentioned earlier medical and government occupied building sales. Do you see a significant difference in the interest rates on those, call it COVID-proof almost, investments in commercial properties versus your normal suburban office building?
Yes. Yeah. In short, the office building we sold in Berkeley really quickly was an institutional REIT from Texas. So I think that they were self-financed on that. It was a trade buyer for the government occupied building in Sacramento with a bank relationship and many other assets. So I think they got favorable financing because of that. So there's a story.
Okay. Good. Max, do you want to open it up to Q&A?
Yeah, thanks. I'll just start reading off some of these questions in the Q&A box. The first one, more towards the brokers. Has your commission structure changed due to COVID, and any detail you want to add to that?
If you want me to start on that one, I think in short, has our commission structure changed? No, it has, at least it has not been negatively impacted. If anything, landlords are starting to be a little more open to making the commission structures more appealing, whether it be paying not necessarily a higher rate, but maybe a per square foot bonus, things like that, because everybody's just fighting for business, and anything they can do to see a deal, they're going to try to do it.
I second that.
Mike?
I think there's just been a continued some pressure on compressing sale fees, and on the private side, it's very much a relationship business. So in every instance is different. Some of them we continue with market fees, and some of them are we need to do something a little more favorable for our ownership structure, and we'll help you out down the road. So there's been some impact in cases, yes.
Okay.
Got it.
Good.
Next question has to do with San Jose. Downtown San Jose has a lot of Class A office buildings being developed currently. What effect do you think this will have on Class B and C buildings in San Jose? Will they suffer? Will they benefit? What do you see? Chad, maybe start with you.
Chad and Simon, since they're closer to San Jose.
Yeah, I think that there's always, and I don't work in San Jose specifically, but I can tell, I know just from, working on both coasts and historically, there's always a flight to quality is what I've found. As soon as there's any change in the market, it goes back to the old adage that, in a recession, it's not Rolls-Royce that suffers. It's General Motors. Folks with money always have money. So, rents drop, there's a flight to quality. The market picks up, which often drives, an increase in rental rates. Remarkably, there's still that same flight to quality, right? So I think that there's always a place for the Class B and C buildings, because the Class A buildings, especially new development, just price a lot of people out of that market, a lot of companies out of that market, excluding the Googles and the Facebooks of the world, or the big law firms or Deloitte's. But I do think that you're going to have a lot of office tenants that have been kind of stuck, well, not stuck, that's probably not, that have been in Class B buildings for a while. As their companies are doing better, Class A development, you'll see them moving out of those buildings and back into the Class A. So I think it will definitely affect B that way, but there's always companies that are coming back, that are starting up, that are going to backfill those B spaces.
Simon, how about you?
Yeah, I mean, I would apply that same scenario to, our market here at Tri-Valley. And we've seen, not much Class A being built, or we haven't really seen any office buildings really being built, except for owner users building their own building. There hasn't been any spec buildings for tenants have been built over the last probably decade. But if there would be new Class A space, I mean, just like Chad already said, I mean, there are different types of tenants. So I don't think, especially Class C is not going to get impacted by that. Class B, B plus, maybe if the rates are, comparable or close enough, or if somebody would be, it's not that big of a difference, I guess I'll move to the new building. But to answer your question, or the person who threw the question out there, I don't think Class B and Class C are going to get negatively impacted by the new Class B buildings.
Okay.
Thank you. Next question. This one is more for Kurt. Has there been, or do you see a slowdown in SBA lending now that the CARES benefits, i.e. fee waivers and 3 loan payments made, expired in September?
I mean, the stimulus worked. There was a huge demand. And let me go back a little bit. I think SBA lending in general got a really good feel with the PPP program, which was a pretty big success. SBA got a lot of attention with the CARES Act and the free payments. So we have a pretty good reputation, I feel, in general. And a lot of people took advantage of some of those programs. And so now that they're gone, yeah, there's going to be a natural tendency to, oh, shoot, I missed out on those benefits and I'm not going to buy a building. There's going to be some of that, but I think in general, people are going to embrace and go, wait a second, look at this SBA program. I might not get a fee waiver, but I can fix my cost. And any business that owns their, any business owner should really think about owning their own building, because long-term free payments or reduced fees aside, the bigger picture of owning your own building not being subjected to a landlord's whims and changes, increases to the rent, just your own appreciation. All of those good things that the SBA program has is going to, trump the fact that we're not having the fee waiver anymore. So it's a little bit of a hit, but in general, I think there's going to be a big, strong demand. And again, especially as these rates are still super low.
Thanks, Kurt. Last audience question here. What do you see happening with the San Francisco office market? Obviously, COVID has affected it, and current conditions in the city also continue to affect it. Do you see companies moving out of San Francisco towards a Peninsula or East Bay or other parts of the Bay Area?
I'll jump in on that one. I think that there's been a migration east for years and years. I think a lot of people in San Francisco, the Peninsula, have come to the East Bay, and a lot of the people in Oakland Union City are moving to Livermore, Pleasanton, and further east. So I think that's a trend that's here to stay. One of the biggest deals that we did, I was kind of going over some of our deals, office deals that we did in the last year. And we did a consulting firm in San Francisco, bought a $8.6 million property. We did a very large dentist in Menlo Park. You're still going to have people that want to be in those centers, and especially if you're a service provider that your clients and patients are there, you're going to need to stay there. So I don't know, maybe a dual answer to that.
Thank you. Thanks, Kurt. Chad, as we're wrapping up here, do you have a final question for the panelists that can take us home?
Well, I think, the biggest, if you could answer, when's COVID going to be over? Are we all getting back to normal soon? I think that's the lingering question. No, I think that it's just really a matter of just muddling through this thing. I mean, obviously we're working, our clients, we're busy. It's just, as Simon said, smaller deals, shorter terms. Mike touched on, the inability to forecast, vacancy rates. Nobody knows. I think we've got a lot of people just sitting in the wings waiting to see what happens. And, I guess to put that in the form of a question, is there something besides the obvious, and that is COVID just miraculously ending? Is there something that you see that can be done within our power, or that you see coming down the pike that will turn the tides and bring people back to the office, knowing that COVID may never end?
That's a good question. I just think I don't think it's going to be a single event. I think it's just going to be a slow, long-term. It's going to take a while before people feel normal. I think for the most part,
the confidence, right? The confidence of going back.
And that's not going to turn overnight, but
right,
it's going to come.
And it's like politics, right? It's like, I would say it's almost 50-50. All of us probably are like, well, COVID is kind of over. We're all going to continue working the way we always have, right? But then there's the other side. You talk to, we all have friends and, family members maybe that are complete opposite and said, I'm not leaving my bedroom, right? I'm scared to go outside. It's the confidence, just get the confidence back into everybody. And
Mike, would you agree with that?
I do. I think it's something that we probably won't necessarily, I won't necessarily see coming. I liken it to, first off, I think as brokers, we're all optimists, or we probably wouldn't be in this career path. Secondly, I think if you look to what the world did with finding a vaccination for COVID in, I don't know what it was, 12 months, when they'd never come up with a vaccination prior to that in the private.
Unprecedented.
In shorter than 4 years.
Yeah.
So I'm optimistic that we're going to find a solution, but I just don't know what it is and who's going to be working together on it. I think it's going to be collaborative.
Right. All right. Well, everybody, Simon, Kurt, thank you very much for joining. Max,
thank you.
Appreciate you putting this together.
Absolutely. Yeah. Thank you. Thank you to all the panelists. This was great. Very informative. Thank you to the audience. We had a great turnout. Hope you all enjoyed it. Look forward to the next one and have a great day.